What market crash are you talking about, bro? Well, I ain't talking about Bitcoin. I ain't talking about the NASDAQ, nor euro, nor dollar. I'm talking about the yields. And it's so important that we focus on the yields because that's going to tell us where people are putting their mullah. Welcome to today's video. I'm going to be diving into the yields and helping you understand where money is right now in terms of investor sentiment. And we've got one thing that could save the marketplace, and that is a stock, Nvidia. It's going to dictate whether or not this rally to the upside is going to continue, and that this move to the downside that we're witnessing across the board is just an opportunity for the marketplace to load up on those longs and get ready for a nice favorable move higher. So let's get with the flavor, ladies and gentlemen. So to put things into perspective, in front of you, we have got the S&P and the 2-year yields and the 10-year yields back in 2007, 2008. Now, articles are coming out saying that the 10-year has now hit the highest level it has since 2007. Well, 2007, 2008 was the subprime mortgage crisis, but we need to focus on what was going on before it was actually declared and all the speculation behind it happening. What was the marketplace doing? So in front of you, we've got S&P at the top. We've got the 10-year bond. So this is the 10-year, the blue line, which is the 10-year yield. And then we have the yellow line, which is the 2-year. At that point in time, at the 2007, 2008 subprime mortgage crisis, the market topped out. So the S&P actually hit a price point of roughly around 1,598, okay? At that point in time, the 10-year bond, or the yield, was showing a reading of roughly around 4.689%. So if you went to the government, you would get 4.689% on a 10-year for locking up your money with the government buying 10-year bonds. Happy days. Then we go to the 2-year. At that price point, where you would lock your money up with the government and you would generate 4.2%. Now, those yields were relatively high at that time, but we've got to understand what was going on in the marketplace. There was the fear, and the government wanted to encourage people to put money into the marketplace. Now, you can see that as prices started to roll over, so did the yields. Why? Because people were favoring the safety of the government. People were putting money into the government bonds because they were a little bit concerned about this problem that was going on in the subprime mortgage crisis. Oil at that time was shooting up. So it was evident that the market was starting to react to the fear of what could actually happen if the market was going to collapse because of the subprime mortgage crisis. Then, of course, Lehman Brothers then collapsed, and then all these other banks started to have liquidity issues. There was a big problem, and that led to the market completely collapsing, which is why the yields ended up going into unprecedented areas, 2% on the 10-year, or nearly 2.065% on the 10-year, and then, of course, on the 2-year, you were getting 1.2%. And this was round about this area right here where the market dropped out. So everyone went to the safety of the government. The government bailed out the banks. The government saved them. So the investors saw that as happy days. We're in a good position because the government's got the capital to save the banks. Everything should look kind of good right now. We can now start buying up stocks, which is what ended up happening. The markets then continued to move back up, and then they eventually recovered the whole thing, and then they just went up and they didn't stop. And then, of course, we experienced COVID and all of the madness that unfolded from there. So we know back then we didn't have a problem of yield inversions. Let's look at where we are right now. So here we go. Here's the S&P currently trading at 4,425. Where we at with the 10-year? Well, the 10-year, to make life easier for you, is currently on the 10-year yields. We can see that they are trading at 4.316%. You give your money to the government, you're getting 4.3% on a 10-year. You give your money to the government on a 2-year, you're getting 4.99%. What do you think you're going to do? You ain't giving the government money on the 10-year. You're giving it to them on the 2-year. So that means you don't favor the longer term. You think it's not looking too good. So what does that mean? government doesn't have access to a lot of capital for a longer period of time. You've got 2-year generating you more money, but you've got the 10-year generating you less. You ain't going to be giving the government money to the 10-year bonds. You're going to be putting it in the 2-year because you ain't going to risk your capital for long. You're getting nearly 5% on $1 million. Happy days. I ain't got to lock it up for long to make that return. I ain't going to give it on the 10-year. That's stupid. That's where our problem is. Our problem is that the yields are inverted. Now, what we need to happen is we need to see the yields slump. Some guys in Wall Street are talking about that the 2-year needs to be around the 4% mark for us to really start considering purchasing stocks. That would be a happy medium. But as long as the 2-year and the 10-year are trading at these unprecedented levels, it's going to be hard for the market to sustain itself because ultimately the government needs to pay that. So foreign investors coming along, the government needs to service that 2-year at 5%. If it continues to go higher, they're going to have to service it 6%, 7%. The US has already got a problem with capital given that they lifted the debt ceiling. Money supply is getting tight, 5.25% on the interest rates with another interest rate increase. What the next part of this video is, of course, with very bad lighting. I know it's not good. My face is all dark, but we do dive into a bit of detail about what we can expect with cryptocurrency and Bitcoin. So I apologize, ladies and gentlemen. Back to the madness. So what does that mean for Bitcoin? Well, look. Most of you are probably looking at this saying, yeah, baby, Bitcoin's taken a slump. I'm happy with that. Start loading up on that bad boy. You know what? Most holders are, in principle, behaving like smart money traders or smart money banks, whatever you want to call it, because you're buying as prices are dropping. That's the correct thing to do. You always want to buy an investment for less so that you can sell it more later. But the idea is to make sure that if you are buying Bitcoin as it's dropping, that you can absorb that. Do you have access to infinite capital? Well, maybe not so much infinite capital, but can you realistically absorb the drop in Bitcoin? What if Bitcoin goes up at the end of 2024? What if it goes up at the end of 2025? We won't know what's going to happen. Now, what we got to focus on is the fact that, yes, Bitcoin is approaching the halving. So naturally, that by the law of supply and demand says once the halving comes into play, it will naturally encourage Bitcoin's price to go up more. I get that. But as it stands right now, where we are economically, without even talking about the problems in China, China's trying its very hardest to stimulate its economy. Because if China goes, ciao, ciao. That's what is going on with the marketplace. China is responsible for the world's economy. That's my opinion, because it's the world's factory. Everything you buy, China. This laptop, Chinese. This camera, China. This top, bruv, China. That's the problem we've got. They all get it from China. Now, if China is slowing down, it's a bit of a problem. Which is why you're seeing oil starting to pull back, because the demand from China ain't there. And China's the one that consumes most of the oil. Now, with that being said, looking at Bitcoin's price action, we can blame other things for it. I mean, they're talking about the optimism for this Bitcoin ETF approval has pretty much been the reason why Bitcoin's dropped. Going to be parking it to the idea of 2024 before anything happens. All right, cool. SEC gunning for the Coinbase. All right, cool. You got Binance, got SEC knocking on the back door. Cool. How much shit is going on in cryptocurrency? I'd say Bitcoin's doing pretty well. All right? It's doing fine. But we need to consider, from a technical point of view, where we could expect Bitcoin to end up, on the idea that if the market yields, the bond market, if the yields crash, is that what will sustain Bitcoin's move to the upside? And the idea is, when could they crash? What event could lead the yields to crash? Well, in the shorter term, I would want the yields to drop on the idea that Nvidia surpasses its earnings, tomorrow, ladies and gentlemen, Nvidia will be declaring its earnings at the close. Cheers, bruv. Thank you very much. Why not declare it at the open? Why do you have to be out of hours? Well, there's a number of reasons for it. Maybe it's because that's the time that they declare it. Cool. Or is it because the volatility will be too much in the marketplace? The only market that is open at that time is the Asian market. The markets in the US close, Nvidia declares its earnings, so there's probably going to be an influx of trades hitting the pre-market. So those of you that have a certain plan on TradingView will get to see if Nvidia's price gaps up or down. It's going to be very interesting because if Nvidia misses on their earnings estimate, that is pretty much going to put the nail in the coffin and the markets will continue with this move to the downside. Okay? The market is already in a corrective mode. We have got one last line of hope. And if Nvidia delivers, that will then fuel NASDAQ. That will then fuel Bitcoin to come back up and recover this red vector candle zone. It is a coin toss. That's where we are. We're all relying on Nvidia. Some people will say, no, we're not. But Nvidia, with a market cap of $1 trillion, has a lot to lose if they don't hit their estimates. Because then it will just prove that this AI story, well, it was just a bit of a fad. And Nvidia exploded in value. It's from $230 to nearly $438 a share. Ladies and gentlemen, this is crazy, okay? Madness. $1 trillion market cap stepped up there with Amazon. Amazon's been knocked off its peg or two. No longer $3 trillion, but still $2.5 trillion, $2 trillion market cap. That's where we are. That's what we got to look forward to, ladies and gentlemen, from now until tomorrow evening, UK time, 10 p.m. At the close of the New York session, Nvidia will declare its earnings. And what Bitcoin is getting ready for is some big volatility. If Nvidia hits and they succeed, Bitcoin will come back up and recover this vector candle because naturally the NASDAQ will then explode to the upside. The S&P will explode to the upside. Money will go back into the markets. Risk will be back on. The yields will then drop. And that's the crash we're looking for, ladies and gentlemen. The crash in the yields. I hope this makes sense to you. Mad love and respect. Hit the subscribe button, do what you need to do. And I'll be checking in with you bad boys tomorrow. Take care of yourselves, gang. Peace.